Imagine you walk into the greatest pizza shop in the world. The smell hits you, fresh dough, melted mozzarella, basil straight from the garden. You look at the menu and you see a pepperoni pizza for $20. But here's the thing, you don't actually buy the pizza. Instead, you pay $2 just to reserve the right to buy that pizza at $20 anytime in the next 30 minutes. If the pizza's price jumps to $30 because a celebrity walks in and wants the last one, you still get it for $20. You just made $8 profit. But if nobody wants pizza and the price drops to $15, you just walk away and lose your $2. That, my friend, is options trading.
So let's set the scene. The pizza shop is the stock market. Every day it opens, people come in, prices change, and there's a whole lot of action. The pizzas on the menu, those are stocks. You've got your classic pepperoni, that's Apple. Margarita, that's Tesla. The weird anchovy and pineapple combo nobody orders, that's some penny stock nobody's heard of. Now, in a normal restaurant, you walk in, you buy a pizza, you eat it. Simple. That's like buying a stock. You pay the price, you own the thing, and hold it until you're ready to sell. But options trading is different. Options trading is like paying a small fee just to reserve the right to buy or sell that pizza later at a price you lock in today. The full menu of all these reservation deals, that's called the options chain. When you trade options, you're not buying the stock itself. You're buying a contract that gives you the right to buy or sell the stock at a specific price by a specific date.
Let's say you're eyeing that pepperoni pizza. It's $20 on the menu right now. But you've got a feeling that this pizza is about to be in crazy demand and the price is going to shoot up to $30. So instead of buying the pizza outright for $20, you pay $2 to reserve the right to buy it at $20 anytime in the next hour. That $2 you paid, that's called the premium. It's your entry ticket. The $20 price you locked in, that's your strike price. Now let's say you were right. Demand explodes and that pepperoni pizza is now going for $30 on the open market. But you've got your reservation. You can still buy it for $20. So you exercise your option, buy it for $20, and you could immediately sell it for $30. That's $10 in value minus the $2 premium, so you pocket $8 in profit. On a $2 investment, that's a 400% return. That's the magic of options, leverage. This is what's called a call option. You're calling dibs on that pizza. You're betting the price goes up. But what if you are wrong? The price drops to $15. Are you going to use your reservation to buy a $15 pizza for $20? Of course not. You just let your reservation expire. You walk away. You lose your $2 premium, and that's it.
Here's where it gets real. About 78% of all options expire worthless. Let me say that again. Roughly 3 out of 4 options contracts end up worth nothing. That's like 3 out of 4 pizza reservations going unused. Why? Because most people are making bets on price movements that just don't happen in time. They paid $2 for the right to buy pizza at $20, and the pizza stays at $19.50. Close, but not enough. Their reservation expires, and the pizza shop keeps their $2. And that brings up a crucial point. Who's on the other side of this trade? Who's the one selling you that reservation? It's the pizza shop owner. In the real market, that's the options seller. They collect premiums all day long from people making bets. Most of the time, they keep the money because the options expire worthless. The pizza shop owner isn't gambling. They're running a business.
Every reservation has a deadline. You can't reserve a pizza today and show up 6 months later demanding they honor the price. In options trading, this deadline is called the expiration date. Options can expire in a week, a month, or even a year out. Here's the critical concept. As the delivery deadline gets closer, your reservation becomes less valuable. If you have 30 days to see if pizza prices go up, that's a lot of opportunity. But if you have 2 minutes, the odds of a huge price swing are basically zero. This loss of value over time is called time decay. Think of it like your pizza getting cold. A fresh, hot pizza is worth $20, but every minute it sits on the counter, it gets a little colder, a little less valuable. By the time it's ice cold and the cheese is hard, nobody wants it. Time decay is the silent killer for option buyers. Every single day, your option loses a little bit of value, even if the stock price doesn't move at all.
Now let's talk about the menu in more detail. You don't just have one reservation option, you have dozens. You can reserve the right to buy pizza at $18, $20, $22, $25, or $30. Each of these is a different strike price, and each one costs a different premium. The $18 strike price, that's below the current $20 market price, which means it's already a deal. That reservation is expensive, maybe $4, because it already has built-in value. This is what traders call in the money.
The $20 strike price, that's right at the current price. This is at the money. The $30 strike price, way above the current price. This reservation is dirt cheap, maybe 25 cents, because the odds are low. This is out of the money. In January 2021, you could buy GameStop call options with a $20 strike for about $1 per contract. When GameStop rocketed to $4.83, those options were worth over $460 each. A $100 bet turned into $46,000. That's the lottery ticket appeal of out-of-the-money calls.
So far, we've only talked about call options, betting the price goes up. But what if you think the pizza shop is about to have a health code violation and nobody's going to want their pizza? That's a put option. A put gives you the right to sell something at a specific price. Think of it like this. You negotiate a deal where the pizza shop promises to buy your leftover pizza for $20, no matter what. You pay a $2 premium for this guarantee. If the pizza drops to $10 because the shop gets a bad Yelp review, you can sell your $10 pizza for $20. You just made $8. Puts are how people profit when stocks go down. They're also how smart investors protect their portfolio, like buying insurance. If you own $10,000 worth of Apple stock and you're nervous about a crash, you can buy put options as a hedge. If Apple tanks, your puts gain value and offset your losses. So let's bring it all together. The pizza shop is the market. The menu is the options chain. Paying a deposit to reserve a pizza at today's price is buying a call option. Letting that reservation expire because prices didn't move is how most options end, worthless. The delivery deadline is your expiration date, and every minute that passes, your pizza gets a little colder. That's time decay eating away at your premium. And all those different reservation prices on the menu, those are strike prices, ranging from deep in the money to way out of the money. Options are one of the most powerful tools in finance. They let you control $10,000 worth of stock for a few $100s. But that leverage cuts both ways. The key is understanding the mechanics before you put real money on the line. This is Make Stock Money. We'll see you in the next one.